Welcome to Synoptics. Today's agenda, we're going to be covering budgeting and its influence on management accounting with me, Trevor Erridge. Before we start with the budgeting exercise and the impact of budgeting on the management accounting function, which drives budgeting amongst other things, I'd just like to highlight a few of the features and functions that are impacting us today. Here's a chart of the Consumer Price Index selected categories of September 2021, showing some of the increases in costs across the board. All items, food charges, energy. And I'd like to highlight just where energy is at this point in time, because these are the factors that need to be taken into consideration. We have become a country very reliant on imports. And here is a chart showing some of the changes in all the imports just in the last year. As a result of COVID and various other factors, we can see that the encircled area shows us a tremendous increase, showing us and meaning basically that we have to take cognizance of what's going on, the external factors that come into play when budgeting, which is part of the management accounting function. A very quick look at the supply chain disruptions that we're seeing today by sector. Look at manufacturing. Look at wholesale trade. These are such important issues that I'd like to drive a point home here on this. When we see the supply chain disruption, 60% in the manufacturing alone, which means that companies like yourselves are looking at business in a very critical fashion, have to take into consideration that there may be issues of having to pre-buy materials 2, 3, 4, and as we've heard, 18 months out. That could have a massive impact on your cash budget. Now let's have a look at how we can see how government is also spending money. These are the costs of civilian workers, private workers, and then state and local government workers, and we can see what a big difference this can make as it becomes clear that we're spending an enormous amount on a growing and increasing size in government, with all the controls that are in there. Again, outside factors that affect us. Look at the compensation, wages and salaries and total benefits, on how this actually impacts us, because we pay this with taxes. So these are the kinds of things that ultimately have to be budgeted for. Where do we go with all of these numbers? And ultimately, what does that mean to your clients, and how does that get brought into the budgets? And when we look at the next phase, which is the development of a contribution margin by product. By sector, let's have a look at what this basically boils down to. Suddenly we have from the Bureau of Statistics the kind of impact in different areas. Look at all items as a 5.3 index increase. Look at energy, 25%. Just energy commodities, 41%. Let's go and have a look at new vehicles or used vehicles has gone up 31%. New vehicles, 7.6%. Look at those percentages. That's all got to be brought in. Gasoline has gone up 42%. I'll repeat that, 42.7%. Everybody uses gas. It's a big part of the energy crisis that we're facing. So budgeting as a basis for management accounting. What is management accounting? It is the practice of identifying, measuring, analyzing, and interpreting and communicating the financial information to managers for the pursuit of the organization's set goals. So a very important role, identifying, measuring, analyzing, interpreting, and communicating this information. Basically, it's taking the details of what we have today, how we perform, what we do, and what do we need to do, and how well do we have to perform in order to achieve the objectives. We will cover that in the next series, which is dealing with the budgeting in and of itself. The intended purpose of a management accountant or cost and management accountant is to assist executives in making well-informed decisions for the future based on current performance analysis. So in other words, what are we doing today? What do we need to do tomorrow in order to achieve the end result that we're looking for? We're not looking at what's happened in the past. The past is a basis for which we utilize that detail to identify where we need to go. This is the compass that we're creating. Where do we need to go? This is your guideline, your map, your Garmin. And it encompasses many facets of accounting, which includes product costing, which we'll see is an important part, but very importantly, budgeting, forecasting, and various financial analysis. So the management accountant does what? He helps in forecasting the future. And accurate forecasting helps decision making and answers questions like, should the company invest more in equipment? Have we reached our capacity? Do we need to outsource? Where do we go with this growing business? Hopefully it's growing. What do we do about the equipment if we have a receding business? Same problem. Should we diversify into different markets and regions? Have we reached a capacity based on certain factors? What is it that's driving those factors? Is it a change in the demographics? Change in the generational requirements? And or should we buy another company? Does that help to support, supplement, and do what for our company? Decisions that help to be able to make a brighter future for the company by giving the executives some of these guidelines. And it all boils down to money. Everything boils down to money. They help in making buy decisions. They give insights and on cost and production availability, and are the deciding factors in purchasing choices to empower decision making at both an operational and strategic level. They forecast cash flows, estimating cash flows and the impact on cash flow on business, and they define where and what companies' costs are and where they will determine their revenue from, and they can help business make their next moves. Management accounting also involves the creating of budget and trend charts so that we are able to see what the business has been doing in the past, and so that managers can use this information to decide how to allocate money and resource to generate the projected revenue growth. They also help to understand performance variances. Performance discrepancies in business and variances between what was predicted and what was achieved, that's inevitable. A big point here, it is absolutely critical for us to be able to do an accurate budget, because otherwise these performance discrepancies and the variances will be so large that it takes ages to be able to identify and validate what are the variances and why. And if it becomes just a fact or a form that the budget was bad, we get to the point where every single month there will be the same answer. Well, the budget wasn't up to scratch, the budget meant this, the budget was wrong, etc. They also use these analytical techniques to help management build on positive variances and help to manage the negative ones. They provide insight to management for success. So understanding and creating accurate financial and operational performance budgets with the aim of achieving the corporate's defined strategic objectives and providing the appropriate guidance to executives by defining how we get there. So what are the facts that we can glean from budgeting that go into this function? Number one, management accountants help, and management accounting helps to define whether or not each product generates a contribution. Now, in this instance, it is imperative that all products at least make a contribution. And we need to make sure that as we look at what that is, we also take into cognizance the impact of discounts and freight costs and applied overhead that help us to define the pricing. The last thing you need is for a product not to create a contribution, let alone a small profitability that ultimately gets overwritten with some of the other costs that come into play, like the allocation of overhead, which is a little different. Another important factor is what is break even? And within each product, there's a break even quantity in either units and or dollars that needs to be known. And what is the corporation break-even ultimate in dollars? These are all factors that come out, and budgeting is, or accurate budgeting, is the conduit to helping to define these numbers accurately and in a clear fashion so that the corporation understands where they are and what they need to do. From budgeting, we also understand capacity constraints. Can the current capacity meet the company's growing demand? Or must certain equipment be replaced because it's not complying with the standards that are set? In other words, it's getting old, it's getting costly to not only maintain, but it's not keeping up with the production runs and standards. And what is the cost impact of replacement? And how does that affect performance, efficiency, and output? We will have a look when we get to budgeting exercise that these are small factors that have to be taken into consideration when looking at a budget. It's not just a case of, well, increase the sales and just cut costs. In some cases, we cannot cut costs to profitability, but what we can do is on the production side, we can certainly go and look at our performance, our efficiencies and our outputs, and quality and yield, and make sure that these are some of the factors that will help to generate a different bottom line. Budgeting and the management accounting functions help to determine material and labor requirements. And as we know that labor shortages and material shortages in particular could have and do have a great influence on production costs and ultimately the contribution margin. Let's look at that one or those two issues. Materials today are not available. Supply chain, as we saw in many areas, is costing a lot of money. And it's creating companies to have to tie up their capital in additional inventory to be able to survive and support the customer. Labor shortages are an enormous problem. So now we're looking at the output, your efficiency in performance. We cannot get labor to come in. We don't have enough people, so we have to do with what we have. And those things ultimately generate additional costs to what you may have, and again, ultimately affect the contribution margin. We've spoken a bit about the supply chain concerns on cash flow, but does the current supply chain dilemma impact the lead time of goods for you right now? We've seen that in some cases, this very same lead time can result in a lead time of up to 18 months that people put their orders out there or have to purchase. Can you imagine what an incredible impact it has on the cash situation or the cash budget? It also determines whether you're going to need financial assistance to be able to manage some of this debt, and then can you service this debt in the interim? These are all factors that need to be brought in when building these budgets. These are the internal and external factors that need to be considered. And another one is the impact of inflation and other rising costs. As we've seen, the likes of fuel and various other costs impact the profitability, and it's across the board in manufacturing. And if we don't bring those in, we don't understand what drives it and what the ultimate costs are. No longer are we at the $1 something per gallon of gas. It's now significantly different and getting up there. And as you all have transport costs, these are things that come into play when driving and building a budget. Now let's talk about a very important concept on the margin, on the management accounting side, and that is to determine from a marginal costing perspective the Cvp analysis, which is the impact on the cost of a product by adding additional units of production, and it is useful for the short-term economic decision making. So what are some of the considerations? The contribution margin of a specific product is the difference between the sales price minus the variable cost. Each product contribution has an impact on the overall profit of the company, and every product should at least meet this requirement. The margin analysis flows into break-even analysis, which involves calculating the contribution margin on the sales mix to determine the unit volume in sales units at which the business gross sales equals its total expenses. In other words, what we're trying to determine, what does the business have to sell to cover its expenses? And we'll see how that comes into play very shortly. And the break-even point analysis is useful for determining price points for products and services. Now let's have a look at what we have here, which is the contribution margin. Ultimately, this means nothing more than the sales price minus the variable cost. At this point, every product should have a selling price that is greater than their variable cost, which is materials and labor. And through accurate budgeting, Synoptics will be able to provide these figures for you to use to generate a break-even analysis by company or by product. So let's have a look at what do we need to do and what does the cost volume profit analysis actually tell you. The CVP formula can be used to calculate the sales volume needed to cover the costs and break even. What are those costs? We've seen that there are variable costs, which is the material and labor, but every place has fixed costs. You've got salaries, you've got contributions to medical, you've got rent, you've got utilities, you've got energy costs, etc. So these are all the costs that you now have to cover in order to break even. Otherwise, you don't break even. So the CVP break-even volume formula is as follows. If we take the contribution margin, that's equal to the sales minus the variable costs, and that gives you a differential. That is what we call a contribution margin. It's not a profit because we haven't really achieved the enough dollars to cover our fixed costs, our rent, those things. So we use that number to get to the point of determining our break-even. Now, the contribution margin is used in the determination of the break-even point of sales. So let's have a look at break-even sales volume, dollars. In other words, if we now take our total fixed cost, and we divide it by the dollars that are left in our sales contribution margin, we're going to identify the total dollar value of sales that we need to break even, so that when you look at that dollar value, you'll say at this point we have reached our total sales dollars that cover all the fixed costs and the variable costs, and now we are $0 out of the pocket. We can also look at the break-even sales quantity, which is calculated as follows. Determine the average sales price per unit by dividing the total sales dollars by the number of units sold. That will give you the average selling price per unit. We'll do the same for the variable costs, which is your material and labor. By the total number of units sold, will give you your variable cost per unit. And then one minus the other will give you your contribution dollars per unit. And then if we take our total fixed costs, again the dollar value, and divide it by the contribution unit per unit of sales, we'll come up with a total number of units that need to be sold to be able to make your business survive. And this can be done on a detailed month-by-month situation where you have fluctuating sales requirements. Your fixed costs remain your fixed cost, but at least you want to know that in each and every case, in each and every month, what is that number that you have to achieve to be able to sell? As you move things up and down, as you change prices, these are important factors. So what are some of the key takeaways? The cost volume price analysis is a way to find out how changes in the variable and fixed cost affect your firm's profits. And companies can use this formula result to see how many units they need to sell to break even. Okay, let's have a quick look at what that looks like on the chart over here. So first of all, here's your break-even analysis. You can see that we have a line starting at the bottom left-hand side, which is your revenue from 0 units going up along the scale at the bottom to the total number of units sold will give you a total revenue number. So the more units you sell, the more revenue you get. However, your costs start a little higher. As you can see that the cost line starts at the basis of fixed costs. And you can see on the right-hand side where the fixed cost line is, if you draw a parallel straight across there, that is exactly where your fixed cost starts. So in other words, that's where your cost basis needs to be projected from. Now your variable costs will be anything that is incrementally above that. So for each unit of measure, so you will have more variable costs. In other words, you'll have more materials, you'll have more labor, and so that line kind of moves along. Now you can see that at the next point, we've come to, which is my break-even point, which is highlighted with the circle A. At circle A, if we draw a line parallel to that to the left axis, then we will determine point B, which is what is my revenue dollars that I need to make in order to break even. And below that, in point C, we'll have our units to be sold in order to meet that break even. So, big analysis, great way to be able to have a look at your business. This is what budgeting brings to you. This is what the management accounting function brings to you, or the cost accounting function, so that you can have a look at it. And it's critical that in many instances, and in all probably instances, you should look at this at least from the company's perspective, but better still to look at it by product or product group if you can do that. Here's an example of what the analysis might look like, where we've got total sales dollars, total sales units. That gives me my total average sales price per unit of 404. You've got my variable costs at 20 million. My total number of units sold, same as what they were above, which gives me my average variable cost of 92. I get a contribution margin of 312. And if I take my total fixed costs at 4,381,000, then I can see that my total break-even in units will be 14,000 and my total break-even dollars will be 5.6. So when I've reached those numbers, any one of the two of them on average, then I should be breaking even. And with that, that comes to the end of the influence of budgeting on management accounting, the influence of management accounting in the contribution to make a business successful. We'll see you at the next session, which will include our budgeting and or the impact of budgeting and some of the success and failures in that exercise.